How to choose the right structure for your new business. I started putting together this series of posts as a response to some of the misinformation that's generally available online when it comes to the advantages and disadvantages of the most common types of business entity here in British Columbia and across Canada. Too often, online content is made available primarily for marketing by government agencies who want us to know what they're doing for us, or by new business advisory practitioners looking to drum up new clients. Unfortunately, in business, as in life, context is important. To begin with, we must make sure that we are dealing with Canadian content. Types of legal entities are generally pretty consistent throughout Canada. There are some differences depending on which province or territory you work in. Of course, a great deal of content is available from our American neighbors to the south. While the regulatory regimes are similar, and the entities themselves are somewhat similar in some circumstances, there are a great many different types of corporations in the US, and they have different characteristics from a tax perspective, not to mention the fact that the tax regime there is quite a bit different than ours. Small Business BC originally published this content online until they replaced it with a fee-based service. The fee is only $29 currently, but now a small business law firm is leading the course instead of government bureaucrats. While the law firm is much more likely to understand the nuances than some junior or even senior public sector employees fresh out of university, or even worse, that were fresh out of university 20 years ago, it still is useful to get an accountant's perspective. Accountants deal with accounting for and the taxation of business entities. That's what we do. Generally, accountants are better at understanding accounting, accounting records, and the taxation of small businesses, while lawyers are better at understanding corporate record keeping, legal liabilities, and the details of partnership and shareholder agreements. Each profession provides invaluable perspectives for the new business organization. In any event, I thought it would be useful to go over the advantages and disadvantages of each form of business entity to show the importance of context from the perspective of an accountant. First of all, we'll look at the proprietorship structure. Now, according to Small Business BC, there are 6 advantages and 4 disadvantages to a proprietorship structure. So I'll start with the advantages, go through each of them, and then go through the disadvantages. So first of all, they talk about low startup costs. Certainly, it costs less to start a sole proprietorship than any other form of business entity, all other things being equal, which of course they never are. There is no structuring required, as in a corporation or a partnership, with a corporation needing articles of incorporation and classes of shares and so forth, and a partnership needing a partnership agreement. So you don't need to consider these complexities when you're forming a proprietorship. It is just you. The second issue, they talk about greater freedom from regulation. Here I have a bit of an issue. When it comes to regulation, the type of business is particularly relevant. If you're operating a professional practice, for instance, you'll need to meet the regulatory requirements of your own profession. Taxis are regulated. Building contractors are regulated. Food producers and truck drivers are all regulated. So really, the issue of regulation depends as much on the type of business as anything else. Also, if you hire staff, you will certainly be subject to employment laws and regulations. Third issue they talk about is the advantage of proprietorship in that the owner is in direct control of decision making. Certainly, that is true. A sole proprietor is not answerable to anyone, except his customers and employees, if any. But by and large, he can make the decisions. They'll just tell him if he's wrong. The next advantage is the notion that there is minimal working capital required. The fact is that most proprietorships are small. That's why the capital requirements are minimal. A sole proprietor could operate a large business. In that case, the working capital required would be substantial. So it's not really a function of the type of organization, but the size of business that dictates the amount of working capital required. Another advantage is said to be the tax advantages. So there are tax advantages to a proprietor, and any that there are would indeed accrue to the owner because that's the only guy involved. However, the most notable tax advantage is the ability of the owner to apply losses, particularly losses on startup, against other sources of income. Most other tax advantages actually relate to the corporate structure, most notably small Canadian-controlled private corporations known as CCPCs. So the proprietorship, the main advantage is in startup, if you're expecting losses, you can use those losses and deduct them against income from other sources. Finally, they talk about the fact that in a proprietorship, all profits go to the owner. That is true. There's no one else. The profit will be earned by the owner. They then talk about disadvantages, and they speak of unlimited liability. While it's true, the reality isn't much different for proprietors, partners, and corporate entities. At the beginning, shareholders of new corporations will almost certainly have to provide personal guarantees when borrowing money. Also, sole shareholders will be liable as directors and may need to take out directors' liability insurance. Similarly, partners can actually have more liabilities than proprietors since there's something called mutual agency, which can make all partners liable for the actions of other partners. Another disadvantage is the lack of continuity in the absence of the owner. Again, while true, this advantage is actually more theoretical than real. A corporation with a single shareholder will still be unable to operate if the owner dies or if he gets sick. In a partnership, often the partnership dissolves in the event of a partner dying or withdrawing. It actually depends on the partnership agreement. Then they talk about the difficulty raising capital. Believe me, every small business has great difficulty raising capital. This is not particularly a feature of proprietorships. So raising capital is difficult, but it's not really difficult because you're a proprietorship. It's difficult for a small business to attract capital because you're hard to work with. Finally, they talk about no name protection. This is true. However, you can register a name or purchase a website URL. You can also operate and register a trademark or a wordmark. However, registering a corporation in a particular jurisdiction may actually be the simplest way to protect the name. Of course, no one can stop John Smith Plumber from using that name as his business name. The next common type of entity that gets discussed quite often is partnership. Now, according to Small Business BC, there are 6 advantages and 8 disadvantages to a partnership structure. So let's start with the advantages. Ease of formation. Well, this is probably untrue. While you can form a partnership easily, it's very easy in most provinces to form a partnership almost too easily. In other words, most provinces have a partnership act that provides a kind of default partnership agreement that automatically comes into force when a partnership is formed, unless the partners explicitly prepare their own specific partnership agreement. It's my understanding, and I'm not a lawyer, but that some of these terms may not be desirable. Clearly, it's best to engage a lawyer to prepare the agreement that you want for the partnership, particularly if you don't even know what the terms of a partnership agreement you'll be stuck with from that default agreement. So ease of formation is probably not much of an advantage for a partnership. The next advantage they cite is the low startup costs. Once again, low startup costs assume you won't be drafting a formal partnership agreement, which will cost something, and that your particular business doesn't have a requirement for a significant investment in capital equipment or working capital. That's really more a function of the business itself and the type of business than it is the type of entity. They make the case that partnerships provide additional sources of investment capital. And presumably what's meant by that is that having more than one partner allows more than one person to provide the funding for the business. And of course that is true. They also cite possible tax advantages. Okay, possible, but the same could be true for any other type of business entity. The most commonly available advantage is the ability to deduct business losses against other income for an unincorporated partner in a partnership. But so that is the main advantage. They also talk about limited regulation. The issues here are the same as for a partnership or a corporation. When it comes to regulation, the type of business is particularly relevant. If you're operating a professional practice, you'll need to meet the regulatory requirements of your profession. Taxis are regulated, building contractors are regulated, food producers and truck drivers are all regulated. So really, the issue of regulation depends more on the type of business as anything else. Also, if you hire staff, you will be subject to employment laws and regulations. Finally, a partnership is required to file a separate partnership return with the Canada Revenue Agency. So the notion that it is the regulation is somehow lighter for partnership is a bit dubious, I think. They also talk about having a broader management base, and well, it's not much different than a corporation. You know, I mean, yes, if you have more than one person involved in the business, you'll have more resources to bring to bear, which will include more money and investment capital, but also more expertise. The other side of that is that you can hire management talent in whatever form of business you like. Now let's look at the disadvantages. They talk about unlimited liability. So while true, the reality isn't much different for proprietors, partners, or corporate entities. At the beginning, shareholders of new corporations will almost certainly have to provide personal guarantees if they're borrowing money. Also, sole shareholders will be liable as directors and may need to take out directors' liability insurance. Similarly, partners can actually have more liability than proprietors, since there's something called mutual agency, which can make all partners liable for the actions of other partners. One other thing to point out is that a partnership is a partnership between persons, which could include an incorporated person. So a partner may actually be an incorporated entity, but let's not go there. Finally, or next at least, they talk about divided authority. So when you have partners, or more than one person running a business, there is of course a broader management base, more resources, more management expertise, but you also must consult with other managers. It's kind of the corollary of having a bigger management team. They talk about difficulty in raising capital. I think it's pretty clear that every small business has great difficulty raising capital. It's not really so much a function of the corporate structure or the structure type of entity, but of the fact that if you're small, there's not really a lot of interest generally in your business. They talk about it being hard to find suitable partners. That is true. There's also the possibility for conflict among partners, and that's true as well. Again, they talk about partners binding each other. That's true. That's the notion of mutual agency, and that is a downside of a partnership structure. They talk about the lack of continuity. So if a partner dies, the partnership may dissolve. I mean, it really depends on the nature of the partnership agreement. So if you take on the default partnership agreement and don't draft your own written agreement or unwritten agreement, the partnership will cease to exist if one of the partners withdraws or dies. However, if you have a well-written partnership agreement, you may provide for the retirement or death or what have you of a partner. So it really depends on your partnership agreement. They talk about also the lack of name protection. Well, it's the same issue for a proprietorship. So it is true. However, you can register the name of a partnership, or you can purchase a website URL. You can also operate for a while and register a trademark or a word mark. However, registering a corporation in a particular jurisdiction may be the simplest way to protect a name. So there you have it. Those are the main issues for a partnership. So in the last section here, we'll look at corporations and the advantages and disadvantages of forming a corporation for your business. Now, according to Small Business BC, there are 8 advantages and 7 disadvantages of a corporate structure. So let's look at the advantages first. Limited liability. Now, it's really much more theoretical than real. For an early stage business, if you're going to borrow money, you're probably going to need to give personal guarantees, which means you don't have unlimited liability. You're guaranteeing the debts of the company. Virtually no lender is likely to lend you money without a personal guarantee, and a personal guarantee will hook you into unlimited liability. You're also possibly liable as a director, particularly if you're a sole shareholder, since you'll be also almost certainly the sole director unless you can convince someone to act as your director. You probably have to pay them. So if the company makes bad decisions, for example, not paying employee source deductions, you could be on the hook as director for any shortfall. Or your spouse may also be jointly and severally liable for unpaid wages or source deductions. They talk about tax advantages, and yes, small Canadian controlled corporations known as CCPCs qualify for a much lower rate of tax than other types of corporations, and you will be able to manage income personally and be able to defer some tax. However, most new businesses have high startup costs, and if you end up in a loss position, a corporate structure may not be as tax efficient in the beginning. There are also a number of tax incentives that work better with corporations. For instance, scientific research and experimental development, or BC Interactive Digital Media tax credits, venture capital corporations, and so forth. They also cite the notion of specialized management. So whether you serve as a proprietor, partner, or president, you only have as much experience as you actually have, or as you choose to employ. Simply put, you won't become a better manager because you incorporate. So, that's really a function of who's on your team, including yourself. They talk about transferable ownership, but once again, this is really an hypothetical advantage. You can only sell a small business of any kind if you can find a willing buyer. The hard part is finding the buyer. They talk about continuous existence. So if you are a key person in your business, the company may continue to exist after you die or leave, but may be effectively worthless unless you plan for succession. For professional accountants in incorporated practices, it is often very difficult to find a replacement. The largest CPA firms make it very difficult to train your replacement in a small firm, since the competency requirements align much better than the work done in larger firms. And the same may be true for other professions. I understand that it's very difficult for a sole practitioner, medical practitioner, to find a replacement these days. Does the corporation actually continue to exist after you withdraw? Well, maybe or maybe not, because you may be the key element in that business. They talk about separate legal existence as a benefit. It is true that a corporation is a separate legal entity, but I kind of fail to see how it's advantageous in and of itself. A proprietorship and a partnership may not be separate legal entities, but they are separate business entities. So explain what the advantage is there. It's not really very clear. They say and cite as an advantage that it's easier to raise capital for a corporation. Again, this isn't really true. It's difficult for any small business to raise capital, period. They also talk about name protection, and that is true, and it may be a good reason to form a corporation. However, you can also own a URL or a website without incorporating. They talk about disadvantages. They say that it's closely regulated. I think it's more true to say that the level of regulation has much more to do with the industry you work in, and whether you have employees, and the types of goods and services you sell. There is more regulation to incorporate than set up a proprietorship, but not much more than a partnership. It is more onerous if you choose to have investors, however, since you must comply with securities regulations. They also cite the disadvantage that it's more expensive to organize. It is certainly more expensive to organize than a proprietorship, but probably not more expensive than a partnership, since you'll need to establish or inherit a partnership agreement. If you don't formally establish one, you'll be subject to the terms of your Provincial Partnership Act. They talk about the charter restrictions. Well, in most provinces, there will be a charter, a set of articles of or memorandum of association that governs the conduct of the corporation. Of course, a partnership is also subject to the terms of the partnership agreement, even if you don't explicitly document your agreement. They also talk about more extensive record keeping. The accounting record keeping is no more expensive than what is required for a partnership. There will be a necessity to meet the requirements of your Provincial Securities Act, however. They also talk about a possible double taxation of profits. In Canada, our tax system operates under the theory of integration, which generally works to provide similar tax results, whether income is earned through a corporation or directly at the personal level. There are some anomalies, but by and large, that's not much of a disadvantage. They talk about directors' liability and personal guarantees. Yeah, well, that's the other side of unlimited liability, meaning that you really don't have unlimited liability, so there are these other types of liability that you may be subject to. So all in all, many of the advantages and disadvantages cited for a corporate structure, or in fact a partnership or a proprietorship structure, are really good talking points and serve to illustrate some of the issues, but really context is vital here. So you need to take what you read with a grain of salt, and you should be consulting someone specifically in relation to the particular business you want to form and what your particular goals are. So we spoke about proprietorships, partnerships, and corporations. That covers the most popular forms of business entity, but there are others. Limited partnerships, or a special kind of partnership, used to restrict the liability of limited partners and leave the general or managing partner with the lion's share of the risk. This is a very complicated and expensive tool, typically not used by a small business. There are also joint ventures, which are comprised of two or more entities. Most often joint ventures are groups of corporations working together for a common end other than profit. In the eyes of the Canada Revenue Agency, many joint ventures actually are partnerships. This is true regardless of what they like to call themselves. Finally, trusts are sometimes used as a business entity. However, the most common form of trust arises on the death of a person. So it's most commonly used for estate planning. These are called testamentary trusts since they come into being as a result of the last will and testament of a dying person. Other types of trust are called inter vivos trusts. Inter vivos are trusts created between living persons. That's from the Latin, in case you wondered. Generally, they're used by a wealthy parent to transfer assets to children. The parent either wants to keep the kids from screwing things up, or else they use it for sophisticated and very expensive tax planning.